Hi, this is Darius Dell here, Senior Analyst on the Hedgeye Macro team, to introduce you to our quarterly investment outlook for the third quarter of 2019. So let's get right into it. Let's start with the wood, our GIP model for the U.S. economy. Coming out of Quad 3 here in the second quarter, traversing into the Quad 4, albeit narrowly, but certainly into Quad 4 for the third quarter of 2019, and then back into Quad 3 for, most likely into Quad 3 for 4Q and 1Q. Why does that matter? Well, if you look at slide 8, our risk management overlay continues to be as rules-based as ever. So what you want to do in Quad 4, there's some things that work in Quad 3 that don't work in Quad 4. From a sector perspective, that's tech and energy. Those go from top three sector longs to top 3 sector shorts. From a style factor perspective, growth gets absolutely hammered in Quad 4, whereas you tend to see growth, particularly quality growth, lead the market higher in Quad 3. So lots of moving parts, but the one thing that remains constant is, as you can say, long bonds, bond proxies, gold, things of that nature. Quad 4 tends to be much more risk off, as we learned in the Q4 and in December, and obviously the warning shot fired across the bow in May. So we're looking at all this visually. On slide 13, we show our U.S. real GDP forecast, sort of traversing down the backside of the cycle peak that we saw registered in the mid to late 2018. Our growth forecast, if you look at on slide 14, with the low on the street for 2Q, that number comes out at the end of July. That's going to be the lowest print we've seen since the first part of 2016. Obviously, we've got a guy in the Oval Office who's going to be pretty upset about that. And we have a guy at the Eccles building down the street who's likely to respond to that with more dovish monetary policy signals and actual outright policy. So again, bonds and bond proxies will continue to get you paid, as well as gold, which obviously had a huge move in recent months. Summarizing our themes on slide 25. So our top 3 themes for the third quarter of 2019 are USA Quad 4, then Quad 3, which I briefly hit on and I'll delve into shortly. Earnings recession, we continue to think that the second quarter of 2019, i.e. From a review perspective, but also reported in July and August, we're going to get this sort of river cards on exactly what we think is likely to be 2 consecutive down year-over-year quarters of earnings. That has a whole host of implications, not the least of which are rising credit spreads. And then lastly, peak USD. So after sort of authoring the bull call on the dollar last April, in April of 2018, we're starting to get signals, both from an economic perspective, but also from a financial market perspective, that the dollar could be topping here. And we would expect, certainly by the end of this year, the dollar to be lower than where it is today. So we want to get prepared, prepare investors for that likely outcome, and prepare investors for all the different ramifications of that likely outcome. On slide 27. So, you don't even need high school level calculus to understand this table here. We bottomed in 2016. We accelerated for 3 years, almost 3 years, into the cycle peak on growth, to the cycle peak on inflation, and to the cycle peak on profits. All that basically occurred right around the same time in mid to late 2018. And since then, we've slowed off the respective cycle peaks on growth. We've slowed off the respective cycle peaks on inflation, and we slowed off the respective cycle peaks in profits. We expect growth, inflation, and profits to all continue to slow here in the third quarter of 2019. We expect profit growth to go negative, which we'll detail shortly. We expect inflation to actually bottom here in Q3, but growth continues to caress down the backside of that sine curve. That's one mother of a comp there in 3Q18. On slide 35, we continue to be very, very concerned about the industrial side of the economy. Consumer spending is likely to hang in there unless we start to see a big ramp in jobless claims, which we're not necessarily forecasting, but it's something that is well within the probable range of outcomes during any earnings recession. But that's neither here nor there for now. But what is here for now is a potential industrial recession, i.e. 2015, 2016. So, factory orders, which was sort of factory orders already starting to trend flat. It could be negative year over year in a couple of months. That 10% comp in August is one mother of a comp. We're not going to do anything positive against that. You look at slide 36, CapEx up 9% in July is an equally uncomparable comp. On slide 37, we've written about this extensively with the very auspicious Q1 GDP report, but that inventory overhang is real. Sort of what this chart shows is the trailing three-quarter sum of the contribution of inventories to real GDP growth. And what you see is that whenever we get to this level, we have a pretty sharp pullback in inventory contribution. So we're going to start to pay the piper here in the coming quarters as it relates to that overhang. And then lastly, on durable goods, we've got that number out today, down 2.8% year over year, a 34-month low. Yeah, no. These comps are real, folks, and if we got, if we're being real Bayesians in how we view the world, what we're learning is that the U.S. economy could actually slow faster than even we anticipate over the next few quarters, and that's something we want to call attention to. On the inflation side, on slide 40. It's really just getting past the cycle peak comps in July and August before we really start to traverse back to the upside on inflation. Sort of had a midsummer lull here, or really just a lull in inflation. Don't forget, we're still late cycle from a full employment perspective. Don't forget that on an annualized basis, energy prices at least will be up a lot. Certainly by Q4, and that's something to keep in mind as well. On slide 45, just sort of reviewing the quad 4 in Q4 playbook. Some of you guys were here for that. Those of you who are new, no change to the asset allocation mix in quad 4. So if you think about falling real interest rates, growth slowing, inflation slowing, that tends to be a boon for gold prices on slide 46. Again, duration, you want to be long duration, you want to be short credit risk within fixed income. Slide 50 rather, you want to be long bond proxies. Obviously, if you think that interest rates are going down, real interest rates are going down, obviously you continue to look at these charts. What's leading the market to highs are not cyclical sectors. They're not the small caps. They're utilities, they're REITs, they're things that do well when the economy is slowing and the Fed is tilting dovish. We continue to like those plays. 58 is another key play in quad 4, home builders. So what you tend to see is a massive outperformance of home builders when the U.S. economy is in quad 4 as mortgage rates fall and housing demand is stoked at the margins. Next theme, earnings recession. Welcome to the earnings recession. If the 9 companies that have reported thus far, and we're recording this on the 26th, are tracking down 25% year over year in EPS growth. No, it's only 9 companies. There's 500 in the S&P, there's 2,000 in the Russell or thereabouts. But, the early read was pretty negative. Let's get into it. On slide 66, just reminding investors of the mother of all comps. So we accelerated for a record 9 consecutive quarters into that 3Q18 cycle peak. As you can see by this chart, going back as far as we can get quarterly data, that is an all-time high in terms of the consistency and the contiguousness, using big SAT vocab words right now, of the acceleration that we are now comping against. Don't forget that May durable goods print down 2.8% year over year. If that's the canary in the coal mine, this could get hairy fast. On slide 67, we're just showing operating margins, kind of hanging out at the cycle peak, because growth's kind of still hanging out at the cycle peak, or at least through Q1. Well, Q2, if you go back to that chart on slide 13, we're seeing a pretty big drop off in growth. And again, going back to that durable goods print, we're being Bayesian now. If that becomes the new norm, the margins aren't going to stay up there. You're going to start to see some revenue degradation as well. On slide 74, I mentioned that inventory overhang. So what we're showing here is the wholesale inventories to sell ratio. We're showing private fixed investment year over year inverted on the right side, along with operating margins year over year inverted as well. And what you see is that anytime you have these big, sort of inventory overhangs, the piper gets paid, folks. The chickens do come home to roost. I don't think by the way, that's a tangent. Chickens don't root. I think roosters root. Let's not get too sidetracked because we have an earnings recession to warn you guys about. On slide 38, or 78 rather, we're showing here just an NFIB small business index, showing forward outlooks for sales relative to cost of labor being the single most important problem. And what you're seeing is just late cycle dynamics. We're slowing off the cycle peak in terms of GDP and CPI, but again, companies can't cut wages, and that's something that we've highlighted in recent decks. Going all the way back to July of 2018, when we authored a presentation titled "Jump Conditions and Wage Growth Are Around the Corner." Well, ever since then, you've seen wage growth, particularly on the private sector side, trend around 3.5%, 3.4 to 3.5%. Certainly over the last 6 months, that's way up from where it was even a year ago, when it was basically 100 basis points below that. On slide 81, how low can earnings go? Who knows? I mean, you go back to the 2001 corollary, no one really knew how to model downside in corporate earnings. And we're not saying we know precisely with pinpoint precision how to do so, but what we can do is formulate sort of reasonable and robust scenario analysis around something we can forecast, which is EBIT margins. So if you look at this table here, just taking EBIT margins down 100 basis points from where they were in Q1, get you down 9 to 10% earnings on a full year 2019 basis. What do you think that means for 2Q and 3Q if consensus is right on that hockey stick in Q4? We don't think investors are positioned for that. On slide 84, and you can tell by credit spreads, being as tight as they are now currently. We're just showing the monthly average of high yield OAS, and what you see is that in and around every single earnings recession, at least since this indicator has been sort of ticking, we had credit spreads blow way past the historical mean. 600 to 800 over is not an unreasonable expectation on high yield credit spreads. Now, maybe they don't get there because the Fed seems to be a lot more, Jerome Powell being from private equity, maybe he's much more aware of this than his predecessors. But again, that doesn't mean cycle risk is done just because Jerome Powell is the Fed head, just because you got a rich guy running the Fed who, might go back to work for Carlyle when he's done. Yeah, no, we still think the cycle matters. On slide 86, who doesn't think the cycle matters? Investors. So what we're just showing is the business conditions index relative to high yield spreads and inverted. And if you just think about the cratering of business conditions that we've seen in June, not May when we were selling off and it was the worst May since 1973 for the stock market. In June, high yield spreads could be 100 basis points higher from here. And we're not even, like I said, only 9 companies have reported Q2 earnings, down 25% in aggregate. Yeah, no, this could get hairy. This could get hairy in a hurry. All right, just moving on. Last theme: peak U.S. dollar. On slide 91 here, we're just showing the euro dollar 25-month delta risk reversals versus the dollar index. And what you've seen is that any time risk reversals start to get to this level, you start to see a pretty big snapback in the dollar. And so effectively the currency market, from both the positioning perspective, with the euro net short positioning coming in, obviously risk reversals starting to creep up here. The currency market's starting to sniff out the peak dollars coming, but it's not necessarily priced into the sort of the surface level area price because we don't think the catalyst has occurred. What is the catalyst on slide 93? It's a recovery in the global economy. So this, the folks that have been with us and those that don't are about to learn this. The dollar, being the world's reserve currency, only goes up when the world economy is in Quad 4. That's effective with the call we authored in April of last year. We said, hey, the world economy is going to go into Quad 4 in the back half of the year. Investors are way too long the euro. In fact, there was a record net long bias in the euro at the time. Well, now we're on the other side of that trade. The global economy is poised to recover in Q3, Q4, and we think the astute investors who are trading in things like risk reversals and futures and these more exotic swaption type markets are really starting to sniff that out. We definitely want you to be paying attention to those signals. On slide 94, so recovery in the global economy, so you basically to get a recovery in the global economy, you need to get the two big sort of economies that have led to the downside, i.e. China and the Eurozone, to stop A, leading to the downside, and B, start to recover. Well, coincidentally, our GIP models, if you look at those, the progression there, has both the Eurozone and China inflecting into Quad 1 over the next quarter. Now, that can be precarious. Whether or not they actually do inflect in a Quad 1 remains to be seen, because I believe if you go back to this time sort of last quarter, our GIP model had China potentially inflecting into 2Q until we got all that nasty April data that was pre-Trump trade tariff tantrum. Trump trade tariff tantrum, say that 5 times fast. It was pre-Trump trade tariff tantrum. So China slowed back in Quad 3. Its economy continues to show evidence of secular stagnation against a mountain of base effects that we'll sort of hit on later. And then Europe, Europe can't get out of its own way from a policy perspective. They don't know if they want to ease fiscal policy or raise or tighten fiscal policy. Draghi just opened the door to more easing, but will that even matter? How much cowbell is really effective there? Well, who knows how much cowbell is effective in Europe, rather? On slide 101, going back to China. What if this red line, and I'll take a second to explain this chart, what we're showing here, and so everyone knows China's national account statistics are very fabricated, particularly if you look at the real GDP growth rates. But when you disaggregate the data, and run the rate of change analysis on yourself, particularly on the nominal data, that's when you start to see impact as it relates to its relationship to the global economy. That's when you start to see impact as it relates to the volatility of the data series. And so we really like to track nominal GDP growth in secondary industries. That's heavy machinery, construction, manufacturing. And what you've seen is that, twice in the last 10 years, when this portion of the Chinese economy that obviously employs the vast majority of Chinese working population, very big political headwind, or very big political sort of goal here for the Politburo. When that gets close to zero, they stimulate. They stimulate hard and aggressive and fast, so much so that growth, the contribution of growth from this sort of old economy type, sector tends to be over half of Chinese GDP growth. Well, they did that again in 2015, 2016. That obviously resuscitate the global economy all the way through the globally synchronized recovery throughout 2017, which ultimately peaked in the Q1 of 18. Well, now we're on the backside of that again. As I mentioned on slide 104, you can kind of see this chart again. The red line is the red line is the same red line, but the gray bars that you see are the base effects. China, which has been secularly stagnating, if you just sort of look at the chart for a decade now, has to comps that it hasn't seen in 5, 6, 7 years. So the comps are getting easier, which, if you think about how our model works, our comparative base effect model, implies the probability of an acceleration against easing base effects is elevated. In fact, for the China model, it's at 75%. That's pretty darn high. It's a good starting point as an investor. But they're still very hard. They're just very, very high. So, you really have to wrestle with this question is can China comp the comps? I don't know the answer to that. The most recent data point, if we were, again, being true Bayesians, Q2, comp the ease. They didn't comp it. It kept slowing. In fact, they slowed even faster in Q2. On slide 105, why is this happening? China's monetary policy transmission mechanism is impaired. We all know that. They've cut the RRR in terms of unleashing liquidity into the banking sector even more ferociously than they did during the Shanghai Accord. That couldn't get interest rates down lower than they were. They bottomed there. There's a reason for that. The biggest reason for that is that China's a net capital importer now. So, they're just starved for credit and they're starved for dollars. On 106, we're seeing that show up in credit growth. This is the most important indicator. China's banking sector continues to be the lifeblood rather of the Chinese economy. The loans of financial institutions accelerate to 15, 16, nearly 17% year over year during the Shanghai Accord. Now we can barely get off 13 on an economy that's much larger. On slide 107. Well, if we don't get a recovery in Chinese credit growth, which I would argue we have not seen, based on all the data that we track, we have not seen a big enough policy impulse to suggest that we're going to see a big acceleration in credit growth over the intermediate term. It's unlikely there'll be a recovery in Chinese domestic demand against those really, really tough base effects. Yes, they're easing, but they're not easy. And then slide at 108, if we don't get a recovery in Chinese demand, there's not going to be a recovery in global growth. You can hinge this on Germany's shoulders. With Germany trying to flirt with recession every quarter. If China doesn't recover, what we're showing here is just exports of sort of key sort of globally oriented economies, being South Korea, Hong Kong, Taiwan, and Brazil. All globally oriented and all very, very tethered to Chinese demand. If Chinese demand continues to slow, where do you think those lines are going? They're going to decouple and just magically accelerate? You think Germany's going to decouple from China? No, these aren't going to happen. So again, we're in a very interesting spot because you could get one final, the currency market in risk reversal terms and in CFTC futures and option contracts terms is starting to move away from the dollar ruling supreme over the currency market. But you could, if you go back to that back test, the dollar is pretty strong in Quad 4, historically has been as the global reserve currency. So you could get one final gas push higher. If anything, the strength of the yen and the Swiss franc relative to the dollar in recent months could actually be a sort of harbinger of that. Maybe we get one final risk-off type sort of market event, a la what we saw in May and a la what we saw in Q4 of last year. And then boom, that could be sort of opening the door to some happy hunting on the long side in places that are beleaguered places, I might add, in emerging markets. So again, we don't want to put the cart before the horse. Again, peak dollar. We certainly want to get you set up for thinking about all the ways in which the dollar could be starting its topping process, all the sort of investment ramifications therein. Just going back to the earnings recession, high yield credit spreads are nowhere near pricing in an earnings recession that could, in fact, if we're, if some of these recent signals that we saw on both the EPS reporting front, but also on the economic reporting front are accurate, then we're not even bearish enough on earnings. We're not even sort of bullish enough on where credit spreads can go, even in the face of Jerome Powell cutting interest rates. And then lastly, quad 4 in Q3 of 2019. That's about as easy as a call as you can make. Just going back to that chart on slide 27. It's color-coded. You don't need me to explain it to you. So lastly, I just want to wrap it up with our thematic investment conclusions on slide 109. So just in terms of what we're introducing with respect to this particular presentation. So we got housing, the Japanese yen, the Swiss franc, and India on the long side. India, one of the few EMs that passes our A/B test from a economic and financial market perspective. And then on the short side, just putting tech back on the short side. Tech's coming. Tech is a long in quad 3. You take it off, you sell it. You sell high beta, you sell oil and gas, E&Ps, you sell energy exposure, and you sell people who don't know how to short sell or who live in fear of their own shadow for not short selling. This is the most obvious cycle peak I've ever seen in my career. Now, mind you, my career has only been 11 years, so it's not really that long. But I do have access to this thing called Bloomberg, and they have a lot of data in there that allows me to go back and study historical cycles, and they all kind of look the same. So when you walk into quad 4 and an earnings recession, and a Fed that may have to wait and see for some data, you could be heading into a pretty material market event this summer, and that's something we want you guys to be proactively prepared for, certainly on the long side of bonds, bond proxies, and gold. So with that, this is Darius Dell, Senior Analyst on the Hedgeye Macro Team, introducing our Q3 2019 investment outlook.